Hello, and welcome to the FI Entrepreneur, Financial Planning for the Risk Taker. This podcast will show you how to achieve FI through entrepreneurial pursuits by developing a well-calibrated and thought-out plan for risk management so that you can maximize the rewards.
Hosted by certified financial planner, enrolled agent, and serial entrepreneur Ben Martinek, this is the FI Entrepreneur, Financial Planning for the Risk Taker.
The information presented in this podcast is for educational and entertainment purposes only. None of the content is presented as investment advice. Consult your financial professional before acting on any of the information presented in this show. Hello, everybody, and welcome. This is Ben and Andrew here with another awesome episode we have for you. Super excited about this. I was with my wife, Deb, and we were discussing mistakes to make in entrepreneurship. Not just mistakes to make, mistakes that we've made and the challenges associated with those mistakes. But one of the takeaways I had from that call was actually just, the difference between when you mess something up for your boss and someone else's company, you don't have to write the bill for it versus when you mess something up in your own business and now you're the one who has to foot the bill. So that's a game changer. That's definitely a difference in being your own entrepreneur is, paying that cost for yourself. But we thought it would be great to then go and talk about mistakes that we've seen people make in financial independence and what steps or considerations could we give to, avoiding those mistakes. So I'm joined today not with my robust co-host, right, Andrew? What do you want to be referenced? I love
I'll take robust. Robust. I guess it's better than like bellicose or something or rotund. I'm trying to move away from the rotund. I'll go with robust.
I'll go with robust too. Yeah, bellicose. I don't know. You could have a bellicose nature to you. I
A
can see
little,
that.
yeah, a little bit.
Andrew's from New
Sometimes
York,
depends on
folks.
the day of the week.
It comes out. Yeah, he's like, all right, you got a little New York temper going on here. Everybody, watch out. Yeah, don't fire
Only when
him
I
up.
drive, walk, or breathe.
Mistakes to make in hiring. No. What do you think, Andrew? No?
Hey,
That's not
you're
what this.
paying for it every day.
That's not today's episode. No.
I'm not listening to the mistakes episode on
No.
purpose. I'm afraid we'll just come out in that one.
No, it's
Yeah,
all good.
this is going to be mistakes in financial independence, and it was a pretty interesting research project and kind of something to think about. And putting together this outline was kind of cool. And at this point, we're just kind of imagining that you are financially independent or you're very close to it. In this episode, we don't care how it happened. It's here. You're free. We're about to be free. And what are the mistakes happening at this point, at this transitional juncture?
Right. Well, and you're thinking the number one mistake is playing it too safe, right? This is actually inspired folks by Mr. Money Mustache. He recently had an article that we'll reference in the show notes called Why You'll Never Run Out of Money, which is kind of, a nice
Yep.
provocative title. So go be sure to take a look at that with Mr. Money Mustache. But, he had a takeaway and we were inspired by this of like, look, people tend to wait too long, They feel like they always got to work another year and got to save a little bit more and they don't have quite just enough money to get them through any eventual probability or possibility and really it's just a mistake of playing it too safe. Why is that a problem? How can that be problematic for somebody, Andrew?
Well, for me, and one of his main points in that, of course, is that you don't live. You don't live your life. And so I think, especially in the FI community, a lot of the people are pursuing FI to retire early. And there's only two ways to do it, right? You either make more money or you spend less money. And for a lot of people, the default setting becomes spend less money. So during your working career, during maybe the 10 or 20 years it takes to get you to FI, you get hyped up into this hyper frugality. And then it gets very difficult to flip the switch into saying, all right, not only am I not working, but I am now spending down. And seeing that balance change, I think, is really hard for people. And without the ability to give yourself permission to make that change, you wind up really missing out on what the whole point of pursuing FI was in the beginning. And that is to get out of the rat race, to live your life on your own terms. But, if you're only treating the prison of employment for the prison of your own mind, what are you getting at the end of the day?
Yeah, neither one's really independent or that of financial independence or financial freedom as we also like to call it. It's a tough thing. I mean, let's just give some folks credit for why they would want to play it safe. I mean, your focus, so much of your life, your career is building up that nest egg, seeing your accounts grow, things getting bigger, seeing returns. And now, we're going to put demand. That portfolio has gone 20 or 30 years, maybe just 10, depending on how aggressive you are. But it's gone a while without any demand being placed on it. The money just gets to grow and grow and grow, and you get so excited about it growing. Now we're going to start to stymie it. We're going to start pulling money from it. And, it shouldn't necessarily, wouldn't hope that it's going down significantly in value and flipping the other way because, you'll run out of money if you're not careful. But it's not going to grow as much. We're putting some demand on it. It's had the last 10, 20 years to just kind of do its thing. And we're not going to do that anymore. And so I think that's just for anybody, whether you're, retiring, let's say when you're 35, as a lot of folks are trying to do in the FI community, or you're retiring at 65, the more conventional age that comes to mind. That's a challenge regardless of just like, oh man, is it okay? I've got some experience with this right now in terms of our own business operations. We've put some money aside in a business to ultimately run us through, a period of time where we don't have as much revenue coming in. This is specific to our tax business. And, you get comfortable seeing the account values in the bank account of a certain level. And then, when your overhead is in excess of that revenue and you got a deficit each month, which is fine, it's planned, it's expected. Like, man, it does, it does upset you a little. Like, shoot, what are we going to do to generate more revenue? So I think whoever you are, like this is going to be a challenge for you, and you should just start to recognize that it's going to be a challenge. But should it keep you? That's really the question we're wanting to get out here, Andrew, right? Should it keep you from getting into FI? Like people can have a sense of like not having enough. And one of the challenges in determining whether or not they have enough is maybe they're overestimating their spending in retirement or FI. Now they think they need more than they actually need, or they don't think they're going to have other sources of income. Perhaps they're ignoring resources such as Social Security or even their home equity or other business ventures or even working part time. That's not coming into play. Like they over exaggerate what needs to be set aside. Do you think that's just kind of where, why do you think people do that?
I think it definitely comes down to fear, right? Fear is a huge driving factor, I think, behind a lot of those things. Not the overestimating the spending, but a lot of the times in our practice, when we talk to clients, we have, something called the Monte Carlo simulation, and we can map out their income from today until they're 90 or 100, even longer. And you just see all these numbers come together and you look at the cash flows and they give you a percentage of success. In 100% of the scenarios out of thousands and thousands, you're going to succeed. You're not going to die with nothing. You're going to get to the finish line standing up, no problem. And so we'll play with different variables there, and the percentage might come down to like 80. And we know mathematically that this means that in 80% of markets, in 80%, you are going to be fine. And only the worst 20 of historical situations where everything goes bad, the Hindenburg crashes on D-Day and then the stock, you know what I mean? Like, it's not gonna happen. But it is like, if you're in a call with someone and you take things from 100 down to 80, it is, like, palpable. You can see it just suck the energy out of the call, and they just don't like it, and it's that fear of, like, the unknown. Like you said, is Social Security gonna be there? Is my job going to be there? Could I get another job of equal value if I had to go back to work? What if we get sick? Things of that nature. And in this scenario, we are talking about people that would have investable assets north of $1 million, right? Like if you're gonna hit fire, if you're gonna pull that trigger on fire, we're saying that you've got assets away from the house of 1 million or more, probably. Assets that you're going to be able to draw on at a 4% rule that are going to contribute and produce like 40,000 a year for you. That's what we're kind of looking at. So this isn't a situation where overnight you would run out of income and run out of money. It would take a heck of a lot to make that happen. So for me, the number one thing is really fear.
Yeah, for sure. I mean, even in that situation where let's say 20% of the time you'd come into failure, that 20% of failure is presuming that you don't make any adjustments. Like you're getting into
And you
the
just
worst
put your head
market
down and
conditions and you're
plow
just blindly.
forward. You know,
That's
stock
right.
market drops,
You just keep
inflation
spending
jumps
like you
up,
always have.
just everything bad happens, and you're like, "Nope, I'm keeping my spending the same way it is, right?
Yeah, obviously, that's not gonna happen. People are gonna start adjusting, which I think is really going back to Mr. Money Mustache's point. Like, look, folks, you're not gonna run out of money because even if things weren't going quite the way you thought they were gonna go or want them to go, you're going to adjust and do things differently here to make this work. Give yourself some credit, give yourself some flexibility, and give yourself a little bit of the benefit of the doubt, and don't necessarily delay this transition and give in to fear. Look, we'll figure it out. We don't have to have this all pinned down and exactly even precise. Have some trust in yourself, which is one of the things I like now about, the FI entrepreneur. We're talking about entrepreneurship as a big focus of achieving financial independence, but really a point of connection between the two of these, the transition into financial independence or the transition into entrepreneurship, I think has the same attributes. We're still dealing with uncertainty, we're still dealing with fear. And really the response in either of these, whether you're transitioning into financial independence or into entrepreneurship, the response is courage. Just a statement to say, look, I'm going to step out. I'm going to put myself out here and we're just going to see. We're going to make the change. Now, admittedly, for folks who are taking more of a conventional FI approach, the challenge, this concern or the worry here is, gosh, in many situations, we've got a pretty good job. It's paying me quite a bit of money. My situation is secure. I don't really have to retire early. I just maybe don't love my job or I'd like to do something else. I don't have to step away from this. Like, there is good reason for why someone might be concerned about walking away from all of that. They can then go and step out on their own. But, if you're going to do it at some point, you got to do it. Like, I mean, if you're going to jump, you got to jump. The cliff, if we're thinking of jumping off a cliff doesn't get any higher or lower. It's not changing. Like, this really comes down to, are you gonna jump or aren't you? Are you gonna do it or not? I think as we look into FI or into entrepreneurship, you just got to say, look, I'm jumping. I'm taking this leap of faith and I'm gonna do this and we're gonna just see what happens next. I'm ready for the next thing in my life. So yeah, that's your movement into FI has to be one of the mistakes has to be overcoming this concern or this issue of fear that we all deal with, that we all struggle with. And maybe a great way to precede FI proper is to start a business because it's a very similar transition. So let's get a business going, and maybe that's a nice little way for you to start feeling more comfortable with making other changes in your finances to make this work. So Andrew, what other mistakes are you thinking? So we got fear is one of the bigger concerns. What else causes people to either delay the transition into FI or just a mistake to make an FI? I think you had an issue here about house purchasing and other items. What else are you thinking?
We dug into that, digging into the idea of fear is a little bit more philosophical, of course. So now on the other side of that, I definitely wanted us to look at some of the more kind of technical items. As financial planners, we see a lot of these things. So what are the technical items that are going to hamstring you? Like now we're talking more like on your way to FI. And so, we did some thinking, we did some talking, and one of the things that stood out to me was some people think that they waited too long to buy a home, and that prevented them from hitting FI sooner. They spent more time renting than they needed to. They didn't build up equity in a home. And for me, and I think also for you, Ben, you'll have to correct me if I'm wrong, we are a little bit less sold on the idea of a home as this make or break piece in someone's financial situation and success financially. So what do you think?
Yeah, I mean, you're really just touching upon this broader question, Andrew, of whether or not it's better to rent versus buy. And you have this in any sort of arrangement, should I rent my trailer, or if I move, or should I buy it and then resell it or something? Or should I lease my car perhaps, or should I buy my car? I mean, probably the home or your home or living situation is the most prominent arrangement of the rent versus buy question. But, it comes up also in other means. And truthfully, it can go either way. Renting can be the better choice than buying, and only buying can be the better choice than renting. Like, I don't think this is an all or nothing, or this it's always right this way or always wrong this way. The question is, what would drive the rental question in my mind is, well, just how much you paying in rent. Like, I mean, only your rent is low enough, and it's what you have is meeting your needs and it's sufficient. Then yeah, without question, renting can be the better choice than homeownership. But there's a lot of variables that go into that consideration. I think the best calculator specific to this, and you could really retrofit this for other items, but the best calculator out there is one that's delivered or provided by the New York Times. Google search New York Times rent versus buy. That's a wonderful calculator for determining this decision. For us, we'll have clients who are paying quite a bit in rent, and they're like, "Gosh, should I just be buying instead?" Some of the variables that come into that are, well, how long are you going to be there? How long are you going to own the home? What kind of additional carrying cost or overhead do you have? What's the interest rate on your mortgage? How much do you have for a down payment? Do you plan to stay in the area? That is probably one of the most critical components because it tends to be, and this is true really of all rent versus buy calculations. The shorter the period of time in which you need the item in play, the more likely rental is better. You think of power tools just to kick it over into something random, right? I mean, there's a local shop here that I like to use, and not uncommonly, some people will, well, I need a chainsaw, so I should just go buy it. I don't know how much do you need this chainsaw, right? I mean, we live out here in Bismarck, so every now and again I do need a chainsaw, and so in those situations, well, either I try to get a friend who will lend me one. That's probably my best arrangement in that circumstance. But I've also rented one from the local place. Why? Because I don't need to spend $500 on a brand new chainsaw, in which once I buy it, now it's just going to sit in my garage and get used once every 2 to 3 years.
Who's getting you to do the chainsawing for me?
That's right. Who needs it? Well, now, and if I get enough friends together, it sounds like we got a business. Here we go. Yeah. Apparently there's a need in the marketplace for renting my chainsaw out to my buddies. If I only need this for a little bit, my point being, then, renting tends to be the better arrangement for this. And so if you're going to be in a situation home-wise where you're only going to be in the area for the next few years, or it's really unclear to you as to whether or not you're going to be in the area for much more of the next few years, we tend to think of the break even in terms of buying as being a 3 to 5 year play. I'm not opposed to having someone rent versus buy. In fact, I know I have a financial advisor that I'm connected with in which they're pretty strong, actually. They advocate very strongly, especially in folks in urban areas where to buy a home is very expensive. This financial advisor advocates strongly to rent instead of buying. They think that's the better decision.
And so in this case, what do they do with those funds that they don't spend on a down payment? What happens?
You have opportunity cost, right? Some of you may be already familiar with this, but this is, ultimately, if I can get more money, buy term and invest the difference. If you guys are familiar with that in life insurance, like if presumably renting is cheaper than what home ownership would be, and now we have a surplus of funds coming to us because it's not going to the home. And one of the things to keep in mind when you buy a home is it's not just simply your mortgage payment, property taxes, and insurance, and all this other stuff that pops up. Once you start owning a home, you tend to want to spend money on that home. This needs to get fixed up, or we need to do a remodel on the bathroom, or we should do an addition, or this home is no longer big enough. We need to get another home. Now we're transitioning to another home. These long term plays of buy versus rent only really play out to be in the favor of buying if it is and stays long term. If we have to keep changing into a new home every 3 years because this one no longer has a big enough of a garage, whatever the reason is, like, this is where you're gonna start losing money on this decision because you're just putting more and more money to it than what you initially thought you were. That's a big consideration. That tends to be something that not uncommonly people will, they become, money pits. But let's just say there is a significant amount of excess, that I don't know, maybe it frees up $1,000 a month or something that you're able to put towards other purposes. What adds to whether or not your long-term wealth is better off is this question of what's the kind of return I could get on the money that's not being applied. But it's also what's the appreciation on the property? Because the thing that you are missing out on home ownership that you aren't going to have in a rental, even with opportunity costs, and even if you are saving money and you're not paying as much on the rental, is capital appreciation and leverage, and that you can ultimately buy a much bigger asset through your mortgage that's appreciating, at 3, 4, 5% a year, that you're not simply picking up. And so even if you're clearing, let's say, $1,000 a month, like you still may make more money in capital appreciation in home ownership if you're in a market where we think maybe you are going to get 4 or 5% on this leveraged asset. Like, yeah, 4 or 5% seems modest, but on a very large leveraged asset versus, let's say we're getting really good returns, maybe 15% returns on that $1,000 a month we're setting aside. That leveraged asset, just because of its size in comparison to what you're actually saving, still will better play. So we've gone really off into a tangent here, and I suppose it's great to talk about this decision. But the best calculator for making the determination on what to do, should you rent or buy, when it comes to homes, without question, is that New York Times buy versus rent calculator. You got to look at that. That's what we do. I couldn't recommend that highly enough. And it goes either way. It really simply goes either way as to what the right decision is. So what do you think, Andrew? Yeah,
Yeah.
I went on a long tangent.
I
Yeah.
think you're shocking. No, I think you're totally right, and I think a lot of it does also come into personality. Like some people just don't want to buy a home. So even if it is like an apples to apples comparison, they are not going to even want to be in that situation, or just a lot of people might not even want to rent. So making that feel like one of your biggest mistakes on the way to FI for me is very ambiguous. The next one, though, for me is very clear, and it is acting outside of your risk tolerance, outside of your investment plan, and really not having an investment philosophy, an investment plan, kind of jumping from trend to trend, letting FOMO or fear of missing out rule your life, jumping on meme stocks or crypto, or even just like buying individual stocks rather than buying diversified funds and not having an overarching philosophy. So, could you talk a little bit about that?
Yeah, I mean, without question, that's an important piece to this. And thankfully, pretty strongly in the FI community is a focus on buying broad market index funds that are fairly inexpensive and quite frankly, just simply do the trick. And, that's what we utilize. We think that's the smart approach. It's the best way to invest in that sort of framework. Now, we got to be careful about talking investing too broadly because there's a lot of different ways to invest. And the most prominent and easiest and most accessible, and probably what we will typically think of when you say invest, is buying into the capital markets and stocks and ETFs, mutual funds, that sort of thing. But that's not the only way to invest. You could certainly build out a real estate portfolio. You could invest in yourself through a business, or you could find private holdings in which you invest maybe in your buddy. We've got actually a friend in which his brother got tied up with a company, and the friend happened to have some money sitting aside, and so the brother came to him and said, "Hey, would you basically be a seed capital contributor to get this thing going?" And he said, "Yeah, I've got the money." And anyhow, the short of it is they're like, "Wait, it's a really good company. Here's the business plan. This is what we're going to do." And as it turns out, this wasn't publicly traded. This is just a private affair. This is, really kind of a one-off deal, and they weren't looking for just any investor. They were working within their immediate network. The short of it is the company's done incredibly well, and my buddy has made a ton of money. It's made a ton of money off that investment. I mean, like independently wealthy ton of money, sort of stuff. Like investments come in various types. Not all of them by any means turn out as well as this has for my friend. It would be a mistake to think of this whole investment decision as just simply broad market index funds. I think that would be too narrow of an interpretation of investing. That said, not uncommonly, broad market index funds are the vehicle of choice within FI and for good reason. But you still have to have a plan, even in implementing those, because the markets go up and down. You got to know what to buy and sell in that volatility. And it's easy to only, it's easy as much as it's counterintuitive. And we know rationally it's not the right way to go. It's easy to sell low and buy high. Like we're kind of wired as human beings to actually do that. We know we shouldn't, but we're wired to sell low and buy high. And so, in the absence of a plan, people will make that mistake without question. And we've seen that firsthand, even when we're working with close clients, where they give us pushback, where they want to get out of the market because it's gone down, and then they don't want to get back into it until it's recovered and rebounded. And it's just like, gosh, and these are smart people, like folks who are accomplished professionals. They still, they'll make this mistake. I would advocate for, I mean, clearly, maybe you want to work with a financial advisor in this space, depending on your competency and comfort level with the whole management of assets. If you're inclined to be a do-it-yourselfer, a great resource out there is portfolio charts put together by a mechanical engineer, really in depth, very analytical, great resource. Even though it's very analytical, I find it at the same time very approachable, which is nice. And he analyzes just a number of various portfolios, for lack of a better term, called professional portfolios, like people who've kind of like, oh, this is how you should invest your money and allocate and spread it across different asset classes. And you'll see that I think there's 12 or 15 different portfolios for consideration. And if you don't currently have like a portfolio, a model portfolio that you're using, but like this is what I live and breathe and die by, like you need one. To be in the markets without that is just it would be a terrible mistake. It would be like going out in the open ocean without any navigation and a sailboat and hoping that things turn out for the best. Like, it's just like you're begging to get whacked around. If you don't have a model portfolio, if you don't have some guide for deciding how you're going to manage your money, go get one. Like, that's the very next step you should do as you move towards FI. People can lose a lot of money in the markets if you don't have a good resource, something to tie you down and keep you grounded in, for sure. What do you think to that, Andrew?
Well, that was going to really be my follow-up question to you, in the preamble to the mistake, it was not having an investment strategy, and I was talking about ETFs, and you dove into the alternative investments a little bit and the story of your buddy. So my question to you is, like, without that model portfolio, how would your buddy even be able to have analyzed and looked at that investment opportunity and said, yes, this is something that I can jump into, right? Like, if you're talking about either starting your own business, investing in real estate, going into a private venture, these are some things that we would consider more risky, right? And probably we would not be taking the lion's share of our investment capital and putting it into that. So, how does the investment philosophy, investment plan, and model portfolio tie into all this? And I think also give us the freedom and take away maybe some of that fear element that we talked about previously and allow us to act on some of these things that might be a little bit more, nerve wracking.
Sure. I mean, how much to put into something is really going to be decided on a personal, individual level, on a person's risk tolerance, right? This particular friend of mine is, by training a Navy SEAL, and you might take away from this that his risk tolerance, since most people can't make it through Navy SEAL training, myself included, is pretty dang high. Like his willingness to deal with uncertainty and the unknown and danger and death and, quite frankly, killing people, because I think he's had to deal with all of that, not theoretically, like for real, literally, is pretty dang high. Like he's comfortable with these sort of risks where, he may be okay to put a good chunk of his life savings into this investment company and let it ride, this new startup, whereas other people would be freaking out over that. Now, general recommendations on this industry wise within the financial services business is to probably not do more than 10%. You know, that's somewhat arbitrarily determined. The presumption is that basically you could lose up to 10% of your portfolio overnight. And if it was just gone, would it fundamentally train wreck your future? No. Most time you probably could lose that much money and be totally fine. But I mean, could you lose also 50% of your money or even all of it and still be fine? I mean, there are plenty of situations of entrepreneurs who've lost everything, went on a business venture, went well, and then the whole thing blew up in their face and they lost everything and came back and made it all, still afterwards. So this is like, your willingness to take a punch and a beating and then get back up and keep pushing on. But our general recommendation when we work with people is 10%. I personally, professionally, would probably not go any higher than 50%. Like that just would be very, very aggressive. But yeah, as you're considering this, should you take some money and throw it into a more aggressive allocation? Yeah, I think so. I think that makes sense. Let's sweeten up some of your returns. 5 or 10% is not an unreasonable amount. But have still some managed, because if things go well, what we have fear. We've talked about that. We also have greed, and if your one thing is now doing really really well, the inclination is to keep putting more and more money into it. And now we've gone from 10% of your money to maybe 50%, or I don't know, 100. You put everything into it. Just because something's going well right now doesn't mean it's always going to go well. You do have to have some reserves that you leave behind, and, just in case. So there needs to be some other guardrail too on the same side. We've talked about fear, some sort of guardrail to get you on the other side, some motivator to get you on the other side of those fears. You need also a guardrail to keep you from greed getting the best of you, because you can make awfully bad decisions when you get greedy. So cool. Well, I mean, I think that kind of pulls us together, man, for this discussion on FI. It's a focus. What do you like? What's the recap here? We got to continue to combat fear and greed, or are those really just the fundamental?
And using that investment philosophy, the investment plan to be your true north when either one of those pulls you too far astray, right? You got to look at the plan, you got to keep updating it, checking in with yourself, and it's got to pass the smell test, I think, all around.
Yeah, and then I think everybody should have somebody that they're working with some level of accountability. Whether that's in a professional capacity, in financial advisory. That's one of our main values is providing accountability by no means or without no doubt. But you don't have to have a financial advisor necessarily to get accountability, but you need to have accountability at some capacity. Because again, what we're combating against is fear and greed, and we're all very capable of becoming overwhelmed and overtaken by both fear and greed. And accountability really is there to help keep those in check and make sure we don't, either we succumb to worry to what might happen, or on the other hand, we don't turn into some big green ugly monster and start pursuing things that are, outside, that defy reason or make sense. So there you go. Well, this episode was almost mere about fear and greed, but I think we had some good stuff too about FI. So hope we all enjoyed what we had to discuss, and look forward to catching on the next one. Thanks for listening. I hope you've had as much fun as we did. If you'd like to learn more about any of the subjects we spoke about, please visit our website for show notes, links, and more. Hit like, subscribe, or whatever button you've got in front of you to show some love. Remember, the information presented in this podcast is for educational and entertainment purposes only.
Remember what Teddy Roosevelt said about the person who strives greatly. If he fails, at least he fails while daring greatly, so that his place shall never be with those cold and timid souls who neither know victory nor defeat. Until next time, keep striving.
Thanks again, and be well.